So Hannon Armstrong Sustainable Infrastructure. The simplest way to explain it is a mortgage REIT, but the things that it buys are assets and debt related to sustainable infrastructure, either being renewable energy, grid resilience, water rights, kind of management sort of things. And so, the very basic mechanics of it is it borrows money and then invests that money. An example of one of its most recent deals is it did a mezzanine loan to the company Sunrun, and it was a mezzanine loan secured by 30,000 residential solar systems, and all those solar systems with their contracted backlogs and things like that. They can get a little creative with the way they invest. So you're going to see them invest in debt. They're going to invest in land underneath a solar farm, for example. They're going to take equity investments, either mezzanine debt, common equity, but it's basically like a portfolio that is managed by them. And the idea being is that they can, invest better than they can borrow, like a mortgage, like very much like a mortgage REIT. And so far, the proof has been in the pudding. The best way to explain their, I guess you can call it their earnings or their operating margin, is their interest rate spreads or their yield spread, which in 2018, they had a 1.4 percentage point spread between how much it costs for them to borrow and how much the yield on their portfolio was. As of the most recent quarter, they report on Thursday, but I can give you a third quarter. And as of most recently, that spread between the yield on their portfolio and their debt has widened to 2.9%. So you've got that, you're seeing a much larger, a widening spread there, which is a great thing. One of the things that they have access to green bonds, these, it's basically access to cheap capital.
Crazy cheap capital.
ESG investing has created this massive demand for climate conscious borrowing and loans and portfolio products. So institutional investors are looking to buy green bonds as fast as they can be printed. So it gives someone like Hannon Armstrong a real advantage when they're going to borrow money. Nice cheap capital, you can invest it in things and get a good spread. Here's the one thing that, like I said, gives me pause to actually adding new money to it right now, and why it ended up being number 5, is that its price right now, it's only a $3 billion company. It's not huge, but the market value of its equity is 2 times its book value of its equity, which for anything in the borrowing, lending kind of business, that's huge. Just to give a counter, Annaly Capital Management, which is a mortgage REIT, they traded at a discount. Their market cap trades at a discount to their book equity. So just kind of gives you an idea. It's an interesting business. It's growing well, and you're seeing improvement across the portfolio. But you tie that sustainable infrastructure word to it, and it gets really expensive.
Yeah, I feel like there's a good chance they could, even as with interest rates going up, I think that's actually going to be a net positive for this company. That's not always the case for essentially mortgage REITs, but I think that's going to prove the case for this company because of their expertise on the renewable side. That's why I rated as high as I did.
The benefit being, of course, is that mortgages are most part they're fixed nowadays. Like the variable rate mortgage thing is not as much anymore. So rising interest rates crushes them pretty fast. Right. A lot of what Hannon Armstrong has is some variable rates, as well as things like mezzanine debts, preferred equity, things that aren't necessarily the bedrock staple. It's 3.7% for 30 years sort of investment.